Look, I need you to understand something that most people won't figure out until it's too late. While everyone's debating whether gold will hit 3,000 or silver will break 30, they're missing the entire point. The question isn't about price anymore. It's about whether you'll be able to get your hands on physical metal at any price when you actually need it. Right now, there's a disconnect happening in the precious metals market that's so profound, so dangerous, that when it finally resolves, it's going to leave a lot of people on the wrong side of history. And I'm not talking about missing out on gains. I'm talking about watching your wealth evaporate because you thought a number on a screen was the same thing as metal in your hand. Let me paint you a picture of what's actually happening right now. The COMEX, the exchange where gold and silver futures trade, shows plenty of metal available. The price discovery mechanism looks normal. Everything seems fine on the surface. But underneath, there's a war happening between paper and physical that's reaching a breaking point. Here's what I mean. When you look at the COMEX warehouse stocks, you see gold sitting there. But what you don't see is that the ratio of paper claims to physical metal has exploded. For every ounce of actual gold in those warehouses, there are now over 100 paper claims against it. Think about that. 100 people think they own the same ounce of gold. This works fine as long as nobody actually wants delivery. But the moment people start asking for their metal, the entire system seizes up. And that moment is coming faster than anyone realizes. Central banks figured this out years ago. That's why they've been accumulating physical gold at a pace we haven't seen since the 1970s. China's central bank just reported their 18th consecutive month of gold purchases. Poland just moved 400 tons of gold back from London to Warsaw. Why? Because they understand that when the music stops, location matters, possession matters. Paper promises won't cut it. But it's not just central banks. Something's shifting at the retail level too. Go try to buy a significant amount of physical silver right now. Not paper silver, not an ETF. Actual metal you can hold. Call around to dealers. You'll find premiums that are $3, $4, $5 over spot. You'll find wait times of weeks. You'll find purchase limits. This is happening while the paper price shows silver trading at $28. The physical market is already pricing in scarcity that the paper market refuses to acknowledge. I talked to a dealer last week who's been in this business for 30 years. He told me something that should terrify anyone holding paper positions. He said in all his years, he's never seen the disconnect this wide. People are paying $33 for silver eagles while the spot price shows $28. That's an 18% premium. That's not normal. That's not a temporary supply chain issue. That's the physical market screaming that paper prices are fiction. Now, here's where this gets really interesting. The industrial demand for silver is exploding. Solar panels, electric vehicles, 5G infrastructure, every major technological trend of the next decade is silver intensive. We're talking about industrial consumption that's already exceeding mine supply by over 200 million ounces annually. That deficit is being filled by above-ground stocks. But those stocks aren't infinite. And once they're gone, once industrial users start competing with investors for available supply, the price discovery mechanism breaks completely. Think about what happened with palladium a few years ago. Auto manufacturers needed it for catalytic converters. Supply got tight. The price went from $600 to $3,000 in less than 3 years. But palladium is a tiny market. Silver is bigger, more liquid, more widely held. When silver's supply-demand fundamentals finally force a repricing, it's not going to be a smooth adjustment. It's going to be violent. And if you're holding paper when that happens, you're going to learn a very expensive lesson about counterparty risk. Let me tell you about counterparty risk, because this is the thing that's going to destroy more wealth than any market crash. When you own a gold ETF, you don't own gold. You own shares in a fund that claims to own gold. When you own a futures contract, you don't own metal. You own a promise that someone will deliver metal at a certain price. When you own mining stocks, you don't own production. You own equity in a company that might produce metal if everything goes right. Every single one of those positions has counterparty risk. Someone else has to perform for you to get value. And in a crisis, when everyone's trying to convert paper to physical simultaneously, those counterparties fail. It happened in 2008 with mortgage-backed securities. Everyone thought they were holding safe assets until they tried to sell them and discovered there were no bids. The same thing is going to happen with paper precious metals, except worse, because at least mortgage-backed securities were backed by actual houses. Paper gold is backed by promises and leverage. Here's a scenario that keeps me up at night. Imagine a currency crisis hits. Doesn't matter which currency, doesn't matter the trigger. Suddenly, everyone wants out of paper and into hard assets. Gold and silver are the obvious choices. Millions of people try to convert their ETF shares to physical metal. The funds can't deliver because they don't have enough metal. They suspend redemptions. Your shares become worthless overnight. Meanwhile, physical metal is trading at multiples of the last quoted price, but you can't access it because you're stuck in a paper position. Sound far-fetched? It's already happened in smaller markets. When nickel went haywire on the London Metal Exchange, they literally canceled trades and shut down the market. When certain bond ETFs broke during the COVID crash, they traded at massive discounts to their supposed net asset value. The idea that precious metals markets will function smoothly during a crisis is naive. They'll break, and when they break, physical holders will be fine. Paper holders will be destroyed. Now, I know what some of you are thinking. You're thinking about storage costs, about security, about liquidity. You're thinking paper is easier, and you're right, it is easier. That's exactly why it's dangerous. Anything that's easy in finance is easy because someone else is taking risk for you, and they're taking that risk because they're making money from you. When the crisis hits, they're not going to protect you. They're going to protect themselves. Let me give you a specific example of how this plays out. In 1933, the U.S. government confiscated gold. They ordered citizens to turn in their gold coins and bars in exchange for paper dollars at a fixed price. Then, after they'd collected the gold, they revalued it higher. The people who complied got destroyed. The people who kept their gold hidden, who understood that physical possession trumps legal obligation in a crisis, they preserved their wealth. Now, I'm not saying confiscation is coming. I'm saying that when governments get desperate, when monetary systems are failing, the rules change. And in those moments, what matters is what you physically control, not what you're entitled to, not what the law says you own, what you can put your hands on. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. I put together a free guide on how gold IRAs work. It's in the description. Covers the mechanics, the custodians, the whole process. Worth checking out if you're thinking about this stuff seriously. Anyway, back to why physical matters. Let's talk about what's happening in the derivatives market, because this is where the real danger is hiding. The notional value of gold derivatives is measured in trillions. These are complex instruments that banks use to hedge, to speculate, to manage risk. But they're all built on the assumption that physical delivery is possible if needed. What happens when that assumption breaks? In 2008, we found out what happens when derivatives markets lose confidence in underlying assets. Credit default swaps, collateralized debt obligations, all these instruments that were supposed to spread risk, they amplified it instead. The entire financial system nearly collapsed because the derivatives became more important than the underlying assets. We're setting up the same dynamic in precious metals, except this time the underlying asset is money itself. Think about the implications. If gold derivatives start failing, if counterparties can't deliver physical metal, it's not just a precious metals crisis, it's a monetary crisis. Because gold is the ultimate reserve asset. It's what central banks hold when they don't trust each other's currencies. If the gold market breaks, if price discovery fails, it calls into question the entire structure of international finance. And we're closer to that breaking point than most people realize. The Bank for International Settlements, the central bank for central banks, just changed their rules on gold. They're now treating physical gold as a Tier 1 asset, the same as cash. Why would they do that unless they're anticipating a scenario where gold becomes more important as a monetary asset? They're preparing for something, and if you're not holding physical metal, you're not prepared. Let me tell you about what happened in Lebanon recently, because it's a preview of what's coming to more developed markets. When their currency collapsed, when their banking system froze, people who had gold could still function. They could buy food, pay for services, preserve wealth. People who had bank deposits, who had paper assets, they were wiped out. Their wealth existed on computer screens that stopped working. Physical gold was the only thing that maintained value and utility. This is the pattern throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina, every hyperinflation, every currency collapse, the story is the same. Paper becomes worthless. Physical assets, especially precious metals, become the only reliable store of value. And in every case, there's a period where you can still convert paper to physical at reasonable prices. Then suddenly, you can't. The window closes. And it closes fast. We're in that window right now. You can still buy physical gold and silver at prices that roughly track the paper market. Yes, premiums are elevated. Yes, availability is tighter than it used to be, but you can still get metal. That's not going to last. When the next crisis hits, when the next wave of money printing starts, when confidence in paper currencies cracks, that window slams shut. Here's what that looks like in practice. Dealers run out of inventory. Mints can't keep up with demand. Premiums explode to 20, 30, 40% over spot. Then spot prices become meaningless because there's no physical metal available at those prices. The paper market keeps trading, but it's completely disconnected from reality. And if you're trying to convert paper to physical at that point, you're too late. I've seen this happen in smaller scale during previous crises. In 2008, silver premiums spiked to $8 over spot. In 2020, during the COVID panic, you couldn't find silver eagles at any price for weeks. Dealers were sold out, mints were shut down, the paper price showed silver at $15, but try buying any for that. These were temporary disruptions. The next one won't be temporary. The reason it won't be temporary is because the underlying fundamentals have changed. Government debt levels are unsustainable. Central banks are trapped. They can't raise rates without crashing the economy, but they can't keep rates low without destroying their currencies. They're going to choose inflation. They always choose inflation. And when they do, when the money printing accelerates, precious metals are going to reprice violently. But here's the critical point. That repricing is going to happen in the physical market first. Paper prices might lag for a while because of manipulation, because of derivatives, because of institutional resistance. But physical metal is going to become scarce and expensive long before the paper market reflects it. And if you're waiting for the paper price to confirm the move before you buy physical, you're going to miss it. This is why central banks are buying now. They're not waiting for confirmation. They're not trying to time the bottom. They're accumulating physical metal because they understand that in the endgame, physical is all that matters. Russia just announced they're going to back their currency with gold. China's been accumulating for years without announcing it. The BRICS nations are building a gold-backed trade settlement system. These aren't random moves. This is preparation for a new monetary system where physical gold is the foundation. And it's not just governments. Billionaires are buying physical metal and storing it in private vaults. Ray Dalio has been vocal about holding gold. Stanley Druckenmiller increased his gold position. These are sophisticated investors who understand markets better than almost anyone. They're not buying paper. They're buying physical. They're taking delivery. They're storing it securely because they know what's coming. Now, let's talk about silver specifically, because silver's situation is even more precarious than gold's. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. That means it faces demand from two completely different sources that can both spike simultaneously. If we get monetary crisis and industrial demand surge at the same time, silver's going to do something that shocks everyone. The silver market is tiny. Total annual production is around 1 billion ounces. Sounds like a lot until you realize that's only about $30 billion worth at current prices. Apple has more cash than the entire annual silver market. If even a small percentage of investment capital tries to move into physical silver, there's not enough to go around. The price has to rise until demand is rationed. And we're talking about multiples, not percentages. Here's a thought experiment. What if just 1% of global financial assets tried to move into physical silver? 1%. That's trillions of dollars chasing billions of dollars worth of metal. The math doesn't work. The price would have to rise to levels that seem absurd right now just to clear the market. And that's assuming mine supply increases, which it can't quickly because silver is mostly a byproduct of other mining. This is the setup. This is why physical metal is your only survival tool. Not because gold and silver are going to make you rich, though they might, but because they're going to preserve your wealth when everything else fails. They're going to give you optionality when the system freezes. They're going to be liquid when paper assets aren't. Think about what wealth really means. It's not numbers on a screen. It's not promises from institutions. It's the ability to command real resources in the real world. Physical gold and silver are wealth in its purest form. They're no one else's liability. They can't be printed. They can't be hacked. They can't be confiscated easily. They've been money for 5,000 years, and they'll be money after our current system collapses. I know this sounds extreme. I know it sounds like doom and gloom. But look at the data. Look at what's actually happening. Currency debasement is accelerating. Debt levels are exploding. Geopolitical tensions are rising. The probability of a major monetary reset in the next few years is higher than at any point since World War II. And in that reset, the people holding physical metal are going to be the ones who survive with their wealth intact. This isn't about being a gold bug or a conspiracy theorist. This is about understanding history and probability. Every fiat currency in history has eventually failed. Every single one. The dollar's been losing purchasing power for over a century. That process is accelerating. And when it reaches its conclusion, when confidence breaks, physical precious metals are going to be the bridge to whatever comes next. So what do? You get physical metal, not paper, not ETFs, not mining stocks. Physical gold and silver that you can hold. You store it securely. You don't tell people about it. And you hold it as insurance against a system that's showing every sign of breaking down. The time to do this is now, while you still can, while dealers have inventory, while premiums are elevated but not insane, while the window is still open. Because once it closes, once the crisis hits, once everyone figures out what you already know, it's going to be too late. This is your survival tool. This is how you protect everything you've worked for, not by hoping the system holds together, not by trusting institutions that have proven they'll sacrifice you to save themselves, but by taking physical possession of real money that survived every crisis in human history. The choice is yours. But understand what you're choosing between. Paper promises that might be worth something if everything goes right, or physical metal that will definitely be worth something no matter what happens. In a world of increasing uncertainty, of monetary chaos, of institutional failure, that's not really a choice at all.